India is growing faster than many economies on this planet. And when things move that fast, you either build a runway or you get run over. Rising incomes are changing the way we spend. And sure, you still have homes and holidays, those are still in. But now, it's about fine art, it's rare wines, it's collectible sneakers, and the wristwatch. Except these don't tick, they flex. Luxury watches are having a serious moment. Now for millennials and Gen Z, they are the ultimate soft power. Status symbols that whisper, "I've arrived," without screaming. Unless it's a Rolex, they scream. And for India's high net worth elite, these watches are more than just heirlooms. They're assets. Because apparently there's nothing like a Swiss timepiece to prove that you've made it and you can afford something that barely needs to do anything at all. Investment grade punctuality. So how did India go from a bargain hunting country to boutique watch buying? Well, first, India's luxury market is booming, driven by a rising affluent class that's done with waiting to reward themselves later. Secondly, enter Switzerland. With the India-Switzerland TEPA agreement phasing out 20 to 23% of customs duties, Switch watches are now waltzing into India with zero baggage. Literally, no duty, no drama. And it's already showing. Swiss watch exports to India have touched 273 million Swiss francs in 2024, and that's a 25% YOY jump. And right in the middle of this horological gold rush is Ethos, India's largest luxury and premium watch retailer, and one of the biggest players cashing in on this TikTok boom. Not that TikTok. Welcome to Bottomline by Groww. Today we are winding open the story of Ethos Ltd, their business model, their financials, their growth levers, and of course, what's taking right under the hood. Pun fully intended. Now let's start with what Ethos is, or who Ethos is. Now Ethos Ltd is our country's leading luxury watch retailer. Now think of them as a curated fancy toy shop for watch lovers. They've got boutiques, brands, and they now even have pre-owned certified luxury watches for those who want to go vintage but verified. Now their journey started in 2003 when KDDL Limited, that's the listed parent company, opened the first Ethos store in Chandigarh. Cut to 5 years later, in 2008, their retail operations were spun off into Kamla Retail Limited, which was rebranded as Ethos later in 2012. Now you jump forward to 2022, they went public, and today KDDL still owns 47%. Now, here's where this all gets interesting. Now, Ethos is built on an omnichannel strategy of two key pillars. First, you've got the physical boutique network. Currently, that's 73 boutiques across 26 cities. A lot of locations offering personalized in-store experiences, from entry-level luxury to ultra-rare pieces that make collectors go weak in their knees. Now, these boutiques rake in about 56% of the company's revenues. And to make all the buyers come back, they have Club Echo. If you're a watch lover, you've heard that name before. Now, their very successful loyalty program, Club Echo, has over 3.3 lakh members, which gives Ethos a treasure trove of company data. Myntra may know your waist size, but Ethos, they know your wrist size. So yeah, the boutique network is number one. Secondly, they have a digital platform. Now, Ethos's website and app are India's largest destinations for luxury watches. Now, they have over 5,800 models across 72 brands. And in FY25 alone, the site saw 18.8 million sessions and accounted for 44% of their total revenue. That's some serious screen time. And Ethos has also built long-term relationships with over 65 of the world's most prestigious watchmakers. Think Omega, Hublot, Rado, Bulgari, Jacob & Co., Louis Monet, Tag Heuer, the who's who of Swiss sophistication. And here, Ethos is focusing on watches priced 25,000 rupees and above. Now, since FY20, they've gone even deeper into high-end luxury. Now, in FY25, luxury and high-end luxury watches made 70% of their total sales, and that's up 48% in FY20. Now, the average selling price more than doubled from 84,000 rupees to a little over 2 lakhs. That's not just premiumization, that's platinumization. And all this has translated to solid money. Now, profits grew at 120% CAGR over 5 years, and it reached 96 crores in FY25, and that's up 30%. Investors are loving it. Now, their stock as well climbed 240% since their 825 rupees listing back in the day. Now, around the last week of June, it traded a little over 2,650 rupees, and that's not bad for a company that's selling blink for your wrist. So, what's fueling all this momentum, right? First, robust revenues. FY25 revenue jumped 25% to 1,250 crore rupees, and that came on the back of strong same-store sales and also volume growth in the premium categories. Secondly, margins grew. Now, gross margins jumped 186 basis points to 31%, and EBITDA margins improved to over 15%. And that's a rare alignment of expansion without excessive spend. Thirdly, certified pre-owned. That's called the CPO market. Now, revenue from this segment surged to a little over 32% YOY. And looking ahead, Ethos has sketched out a multi-pronged strategy to grow revenue 10x in 10 years. Ambitious? Yeah. Doable? That we'll need to see. See, one, luxury diversification is on the cards. They've launched their Remova luggage boutiques in Mumbai store, and that alone did 20 to 24 crores in the first year. Plus, they're opening India's first Messica jewelry store in Delhi. Luxury wrists, luxury baggage, luxury bling. It's now turning out to be a complete package. 2. International expansion. A new UAE subsidiary, Ficus Trading, is aiming to explore cross-border luxury retail. Because if you're going global, you might as well start at a place where gifting gold bars for birthday is completely acceptable. 3. Luxury retail, from 73 to 100 boutiques in FY26. Now, in FY25 alone, they added 14 new boutiques and launched their own crown jewel, a 22,000 square feet store called the City of Time in Gurugram. But it's really not all roses and Rolexes out here. Let's talk risks. Inventory. Now, Ethos ended FY25 with a little over 592 crores in inventory. That's a 35% jump YOY. That's 153 crore more sitting in boxes than last year. Now, inventory as a percentage of sales surged from 5% in FY21 to 45% in FY25. That's dramatic. And the result is that their cash conversion cycle ballooned from 185 days to 215 days. So basically, they're waiting longer to get paid and paying suppliers faster, which is not ideal. And while profits look strong, their operating cash flow is telling you a different story. Negative 20 crore in FY25. So yes, the profits are there, but the cash, not so much. Why? Working capital. See, inventory jumps and quicker supplier payments soaked up more cash than the business brought in. So management is saying that they will pay off as new stores mature and full price sales kick back in. But if traffic slows down, this could get dicey. And another red flag is lease liabilities. Now, Ethos is operating high rent locations, boutiques and warehouses. Now, total lease liabilities more than doubled to a little less than 287 crores in FY25. Now, even if a few flagship stores underperform, it could seriously dent margins. And there's more. Supplier concentration. Ethos doesn't have long-term or exclusive supply agreements with most brands, and that means suppliers could, in theory, say thanks, but no thanks, and move their inventory somewhere else. And that's a serious vulnerability. And lastly, foreign exchange risk. Now, since most these watches are imported and priced in Swiss francs, any rupee depreciation can eat into profits. Now, Ethos is hedging around 50% of this, but sudden volatility will still stink. Now, let's talk about valuation. Now, Ethos is currently trading at a PE of about 74x, roughly its historical average, but more than twice the luxury retail industry median of about 31x. That's not just optimism. That's a full-blown trust into the future execution. But the margin for error here is paper thin. Now, which brings us to the question. Can Ethos keep riding this luxury wave, or will a ticking time bomb of inventory leases and cash flow catch up with it? Let us know what you think in the comments. And hey, if you enjoyed this analysis, don't forget to like, share and subscribe to Bottomline by Groww. Because the only thing that is ticking faster than the wristwatches is investor patience.